Hi everybody, it's Jennifer Smith at Murphy Business of Cape Girardeau, and today we're going to talk about seller financing. Anytime the lending standards are a little bit tighter than normal, there is a real opportunity there to leverage seller financing. And most of the time when I bring up seller financing to a seller, either on the front end or on the heels of an offer, they kind of bristle a little bit and get a little bit nervous about that. So we're going to talk about what that means, and hopefully you'll get a little bit more comfortable with the whole concept, whether you're a buyer or a seller. So let's address sellers first. Basically, sellers and seller financing, either whether you're doing a little bit or whether you're doing a lot, up to 100%, you are becoming the bank. So you get to do all the things that a bank would do in terms of underwriting. We can pull credit, we can pull background checks, we can do fund verifications and ask for personal financial statements, things like that. You get to do your due diligence on the buyer before you take a seller note on it. Incidentally, in the 10 years that our office here in Cape Girardeau has been writing seller notes, we have never had a single seller note default, not a single one. And it's because we do our homework. We make good loans to buyers on behalf of the sellers, and we make sure that there is sufficient kind of teeth in the seller notes, both with security agreements and with personal guarantees from the buyers and their spouses. On the positive side, this is going to sell your business faster. We're going to be able to attract more buyers because they really like seller notes. And we're also going to be able to close faster because we're not going to be waiting 60 or 90 days for an SBA loan to come through. If the buyer defaults, and that is always the number one question, what happens if the seller note defaults? You get your business back. Now, it may not be in the most fantastic condition, but you do get the business back because of the security agreement. You get to keep whatever payments have been made, and we go after the personal assets. On the very positive side of things, this can really be a fantastic tax strategy. You pay your taxes on your sale in the year in which the money is received. So if we're stretching this out over 3 years, 5 years, 7 years, 10 years, whatever, we can keep you in a lower tax bracket and save you some pretty substantial money. Just earlier this week, we were able to save a seller $300,000 in taxes by taking the payments in a seller note over 6 years versus having it all done in a lump sum up front. Now that's substantial. That's real money that we're going to be saving that seller by stretching out the payments. Now keep in mind, this won't work if you're highly leveraged in your business, right? So we have to be able to transfer the assets to the buyer free and clear. So if you have a whole bunch of debt, then you're not going to be able to take as much of a seller note because we have to be able to pay off that debt at closing. Keep in mind, we can also require balloon payments at a certain time period, in which case they would stop paying on the seller note and they would get a bank to take out your note. But again, we've got to think about the tax consequences having to do with that. So sellers, don't be too scared of seller financing. It's really very prevalent, and it can be a fantastic way to help a buyer transition the ownership of your business. Now, buyers, from a buyer standpoint, yes, you're going to be able to close much more quickly. We're not going to be dealing with a lot of the red tape that banks typically have to go through, especially if we're doing something SBA. We can close in a matter of days from the time that you make an offer. We can be super flexible. We can be super common sense because if it's something that you and the seller agreed to, we can bake it into a seller note. You're not going to have a lot of upfront fees. You're not going to have fees rolled into the deal, but you may have a higher interest rate associated with it. So you want to keep that in mind because the seller is taking a risk, and they want to make sure they get paid for that. And there is no guarantee, like when a bank makes a loan that has an SBA guarantee on it, the seller doesn't have that same guarantee. So you may have a higher interest rate. You also want to make sure that you're prepared for you and your spouse, if you have one, to sign a security agreement and sign a personal guarantee, just like you would have to at a bank. So this is not something that if you're not credit worthy, you want to try and go for a seller note. You don't want to put yourself in a precarious position. So hopefully this gives you a little bit more background on seller notes, seller financing, and takes a little bit of the mystique out of it. They're a great tool to help sellers and buyers get deals done, and we're doing them pretty regularly. If you have additional questions, feel free to reach out to us, and we hope you're having a great day. Take care. Bye-bye.